Good afternoon, everyone, and thank you for joining us here at MBS for the Ready for Life Festival, brought to you by the CPF Board in collaboration with Money Sense. If you've just joined us here today, welcome. We have had a day full of great advice for planning for your future, whether it's for your career, your retirement, your personal goals, or even just taking that first step to invest. Now, we're going to proceed along with that theme for the next 90 minutes. Coming up, we have 4 incredible speakers who will be sharing with you bite-sized presentations that could be very useful for your financial decisions as we build resilience in times of inflation. You'll also get a chance to ask them questions during the panel discussion at the end of today's session. Now, you can submit your questions via Mentimeter by scanning the QR code on screen right now or head to menti.com. Now, to kick us off, we're very glad to have someone tell us what is going on in the markets right now, along with the investment outlook. So please join me in welcoming the Managing Director, Investment Strategy Wealth Management Unit at OCBC Bank, Mr. Vasu Menon.
A very good afternoon, everyone. First of all, let me say thank you to the CPF Board and MES as well for giving me the opportunity to be here today to present our views on where we think the markets are headed, where the economies are headed, and the investment outlook. And also thank you to all of you for taking the time, precious time this afternoon to be here, to give us an opportunity to share. So let me dive straight into my presentation because it's a very short one. I've been told I've got 15 minutes. I've got a lot of slides, but I'll try and keep it very short, okay? So the very first slide, this is good news. Right? The first half of this year was fantastic, or at least the first 7 months of this year was fantastic. Markets were all in black, global equities up 17.7%, US equities were the star performer, 28%, but largely driven by tech stocks. And what drove this performance? I think bond yields came down, there was a lot of complacency in the market, everybody thought the Federal Reserve was going to cut interest rates, and that helped technology stocks, helped the market, and you see this picture of black. But if you look at the next slide, in the last couple of months, August, September, you see a sea of red. Everything came down very sharply. In fact, in the last few days, they've been coming down even further, right? And what contributed to this? Largely bond yields. US 10-year bond yields have shot up. I think the realization has come into investors' heads that inflation is going to be sticky, interest rates are going to be higher for longer, and we could finally see a recession in the next 6 to 12 months. The recession is, this is one of the most highly anticipated recessions. It's not happened, but I think it's slowly dawning on people that inflation is going to be sticky, interest rates could be higher for longer, bond yields could actually hit even higher from where they are right now, and eventually all this could, result in a recession in perhaps 2024. And I think if you look at year-to-date performance of the markets, I showed you the first 7 months, the last 2 months, and then year-to-date, not so bad. Equity markets are up 9.6%, but if you invested 2 months ago, obviously you'd be down quite sharply. So things changed quite significantly in the last couple of months. I think what you're more interested in is what the outlook is like, not so much how the markets have done. And if you see, what I've done here is I'm going to characterize the markets, how I see the markets. I would say it's really a tug of war. What's happening is a tug of war between the headwinds and the tailwinds. And of course, you've got a longer list of headwinds compared to tailwinds. On the headwind side, you've got concerns about inflation. You've got concerns about interest rates. You've got concerns about oil prices. You've got the strong US dollar that's creating problems for us here in Asia. You've got China's economic problems, its property market, its economy. You've got recession fears that are slowly starting to set in to markets. You've got the potential for corporate earnings downgrades in the coming quarters. And of course, you've got geopolitical worries. Of course, the latest being the problems between Serbia and Kosovo, right, in Europe. We could end up with another European war aside from the Ukrainian war. And of course, the tensions between US, China, and, the tensions happening in the South China Sea. And of course, on the tailwind side, you've got reopening. Economies have reopened, but everybody is still feeling good. You still see restaurants full, people are traveling. So it's still a good feeling. There's still a lot of pent-up demand. Nobody is pulling back just yet. And the labor market is very strong. You don't see blood on the streets. You don't see unemployment. You don't see people losing their jobs. So, you need that for a big recession to set in, and we're not seeing that just yet. So people are quite happy. They're being employed, wages, and so on and so forth. So let me just go on to first talk about one of the key concerns that the markets have, which is, are we going to see a US recession? I'm going to focus on a US recession because the US is a key driver of the global economies and global markets. And I'm going to present a few charts here, and I'll go through these charts quite quickly. These charts give you an idea of what the markets are saying about whether there's going to be a recession or not. And this number one is a survey done by Bloomberg in September among economists, global economists, to ask them whether we will see a recession in the US, whether it's going to be a hard landing, recession, or soft landing. And essentially, nearly 70% of the economists, actually 73% to be precise, see a downturn in the US economy taking place in the next 12 months, right? But so far, there are no signs of it. The US economy is doing very well. Third quarter economic growth numbers in the US are probably going to be quite strong. It will be out on the 26th of October. But the question is, what happens after that, the fourth quarter, and so on and so forth, right? So economists are saying you're going to see a recession in the US in the next 12 months. Of course, if the US sees a recession, we will also feel the pain. Now, if you look at this chart, this tells you, this actually is a poll among economists to ask them for the probability of a recession. Again, conducted by Bloomberg. And, these are the contributors to Bloomberg. And it shows you that economists actually see more than, or rather, a 60% probability of a US recession in the next 12 months, right? Which is quite similar to the survey Bloomberg conducted in September. Now, if you look at this chart, this is the New York Federal Reserve's chart that tells you the probability of recession in the next 12 months. Again, this chart tells you that, there is going to be a recession in the US in the next 12 months. And the probability is actually probably higher than what you've seen any time in history. This is what the chart is telling you. It's not what I'm telling you, but this is what a publicly available chart is telling you. Now, if you look at the US yield curve, that means the spread between the US 2-year yield and the US 10-year yield, again, what you see is an inverted yield curve. In other words, the 2-year yield exceeds the 10-year yield, and historically, when that happens, it usually precedes a recession. Okay, but again, we've not seen a recession in the US happen just yet, despite the fact that the yield curve inverted some time ago. So everybody's scratching their head as to why, and I'll explain why I think that has not happened just yet. And this chart is something that Jerome Powell highlighted. He talked about it, and he talked about this chart about a year ago. When somebody asked him whether he thinks there's going to be a recession, he says, no, we in the Federal Reserve look at this chart very carefully, and to us, this is one of the biggest predictors of a US recession. At that point in time when he talked about the chart was not showing a recession. But now, if you apply the same chart, which is basically the 3-month T-bill yield now, versus what the 3-month T-bill yield is going to be 18 months later. What it is now versus 18 months later. Of course, the 18 months later T-bill yield is derived from the forward market, from the futures market, right? So if you compare these two, what the markets are telling you right now is the 3-month T-bill yield is going to come down very sharply 18 months later. Now, for that to happen, typically it signifies a recession is coming. And this is what Jerome Powell and the Federal Reserve actually uses. And this is what the chart is showing you is negative. So again, signaling the potential for recession. Now, of course, the other thing that, shows that there's a potential for a slowdown or recession is that in the US, bank lending standards have actually tightened quite significantly. Again, this is a chart that shows you, the lending that banks undertake to large firms, small firms, and so on and so forth. And you can see lending standards have really tightened quite significantly. Okay, partly because financial conditions have tightened, and partly because of, the regional banking crisis we saw at the beginning of the year. I think that spilled over. And so the banks in the US are now tightening their standards, and credit is now less available. Now, why have we not seen a recession in the US despite all these indicators telling us that, there should be a recession? And I think one of the reasons is because of the large fiscal policy that we saw due to the pandemic. Now, because of the COVID-19 and because of the pandemic, the US government launched a massive fiscal stimulus, put a lot of money in the pockets of Americans. Okay, so in June of 2021, okay, excess savings in the US households stood at about $2.1 trillion. So, which means excess savings is not, so you have the normal savings rate, and then this excess savings is above that. So people had no chance to spend. The government gave them a lot of money to try and get them to spend. They were all saving it, not going out, lockdown, so on and so forth. So when, when the doors opened, they had so much money to spend. And they were initially spending it, and they have been spending for the last couple of years. And guess what? Now, according to the San Francisco Federal Reserve, that amount of savings has come down to $190 billion as of June 2023. And by the end of September, that money should have been, the excess savings should have more or less vanished, disappeared. So this excess savings has translated to consumer spending and has helped the US economy to stay afloat despite all the Federal Reserve's massive interest rate increases that we saw in the last 1.5 years. The Fed has increased interest rates by 11 times, by 5.25%, and the Fed fund rate is now at a 21-year high. It should have resulted in a recession historically, but it's not, because fiscal policy in the US has transferred a lot of money, pandemic transfers, we call it, and now that transfers are largely gone. So without the transfers, the economy may not now start feeling the heat, all right, from all the tightening that has taken place. So, as I said, pandemic transfers have weakened. So they have weakened the linkage between US monetary policy and the economic slowdown. But now that they're gone, that linkage could start playing out. Now, the thing is that, earnings forecasts, analysts are actually quite optimistic. They have actually been upgrading earnings. And, so if there's really going to be a recession in the next 6 to 12 months, then analysts are going to be caught off guard because everybody's quite positive, bullish. Now, and analysts are caught off guard and earnings, result coming below expectations, then the markets could react. So, will inflation continue to head lower? So recession is one issue. The other issue is inflation. Will it continue to head lower? It's been coming down. It's been coming down, as you can see from this chart. I use this chart. There are various inflation measures in the US, but I use this chart called the Core PC Index, or the Core Personal Consumption Expenditure Index, which is what the Federal Reserve uses to measure inflation, right? And you can see it's come down, but it is still high compared to the Fed's 2% target. So the latest reading is 3.9%, or to be precise, 3.876420%, but 3.9%. But it's still above the Fed's 2% target, right? So it's coming down, but it has not come down enough for the Fed to say, I'm going to pivot to cutting interest rates or loosening monetary policy. And, I think US bond yields have been rising. Why have US bond yields been rising? One reason is because I think the bond markets are saying that inflation is still a problem. Inflation is still a problem. We don't think we can take our eyes off inflation yet. It's still a problem. It may re-accelerate. Maybe that's what the bond markets are saying, and which is why bond yields are heading higher. Of course, the other reasons why bond yields are heading higher is because Japan, basically allowed its yields, the bond yields for the 10-year bonds to actually fluctuate in a wider range, and that it's effectively tighter monetary policy from Japan. It caused bond yields in the US to go up because what happens in Japan also has an implication on US bonds. And don't forget, the US government is sitting on a massive budget deficit. Budget deficit in the US is now 6% of GDP, which is phenomenal. How does the US government fund all this deficit? They have to issue T-bills, US bonds. And when they issue these US bonds, it pushes up the yield because otherwise, nobody's going to buy it if you... And in this quarter, in July, August, September, they issued $1 trillion, almost a record amount of T-bills, right? So inflation, record issuance of T-bills, and what's happening in Japan in terms of tighter monetary policy or pseudo-tighter monetary policy is translating to higher bond yields. And there are even experts out there in the market, renowned experts, people that have a good reputation. They're forecasting that the yields will hit towards the 5% level, the 10-year bond yields. Closed last night at 4.78, but 5% looks like it's going to happen. Question is whether it will hit much higher than 5%. But, to me, this is something that nobody has really talked about, the re-steepening of the inverted yield curve. So the yield curve is inverted, but now what's happening is the yield curve inversion has steepened quite significantly. So at the maximum point of inversion is 108 basis points. Now the yield curve differential is only, effectively yesterday, is about 26 basis points, although this chart was done a few days ago. So this has only happened, I think, in the last 20 years, 3 times in US history. And the last 3 times it happened when the yield curve inversion, or what we call a re-inversion, took place. It was not the best piece of news because what happened soon after was a recession and a sharp fall in equity markets. So it happened in the year 2000, and in 2001, we had a recession in the US along with the dot-com bubble bursting. It happened in 2007. In 2008, we had Lehman Brothers and then a massive recession in the US. It's happening now. The question is, will it result in the same thing, a recession and a sharp fall in equity markets? We don't know. We'll have to wait and see, but it's something to just keep in mind. So valuations and liquidity, right now the markets are not very expensive. The valuations are below the 5-year average in terms of global equities. So you're not buying at an expensive market. A lot of people are very skeptical. Nobody's been buying like crazy in the markets, except for some tech stocks like Nvidia or whatever it is. But otherwise, nobody's been. You have a very healthy level of skepticism in the market. So people are not crazy and jumping into the markets. They are cautious, and valuations are not excessive right now. But I think this chart tells you that there's a huge amount of liquidity sitting on the sidelines, right? $5.6 trillion in US money market funds. And this money is waiting on the sidelines, waiting to come back into the markets. If you go back to what happened in the global financial crisis in 2007, 2008, there was also a big buildup of liquidity or money market funds of $3.9 trillion. So money market funds is where people park their money until they know what to do with it. It's like T-bills. Like if you guys have bought T-bills, it's essentially T-bills, right? So you put it in there until you see a better opportunity. Right now, back in 2007, 2008, because of the crisis, there was a big buildup of liquidity, $3.9 trillion. But when the outlook improved, that money went to work, fueled a huge rally of more than, 55% in global equities, 73% in US equities. Right now, we are perched up there at $5.6 trillion. The money has not gone to work. It is still waiting for the signal, for the clarity, for the haze to clear. So what are the markets saying? The markets expect the Fed to cut interest rates next year. In other words, the markets expect a recession, and the markets expect 2 interest rate cuts next year of 50 basis points, but bigger rate cuts in 2025, right? So the markets appear to be saying that a recession will happen, the Fed will cut rates, the Fed will pivot next year, right? Hard to say, but this is what the swap markets are saying. So let's just sit back and ask ourselves this question. I'm going to end in the next few slides. So just sit back and ask yourself this question. When inflation eventually comes to pass, inflation is a big albatross hanging over our necks, right? Giving us a lot of headaches, right? Now, eventually, it's like COVID-19. Imagine 2 years ago, 3 years ago, if I was doing this Zoom with you and you guys are not here and I told you, guys, don't worry. 1.5, 2 years later, COVID-19 will come to pass and all of you will be walking out here without a mask. No hard feelings against those with masks, please. Please put on your mask. No, I'm just saying that but we never thought this day will come, right? Seriously, none of us thought we'll fly because hard to imagine when you've been caught in the rut for 2 to 3 years. You just feel like, I don't see light at the end of the tunnel, man. When is it going to happen? And this guy is talking nonsense that it's all going to come to an end. It's in a few months' time, 6 months, 1 year time, 2 year time, it's all going to come to an end and things will start looking better. So it's like that. Inflation as well. It's been bugging us for the last 1.5 years now. If I tell you that once inflation really comes down, what will happen to the markets? I mean, you want to know what's going to happen to the markets. Now, if you go back to 1980s, inflation in the US was extremely high, 14%, right? 14% in the 1980s, right? And there was this guy called Paul Volcker, okay? Imposing for the tall guy, 6'4". He was a Federal Reserve governor, right? But he's a guy that you can't bully. I mean, he's tall and he looks big and nobody dared to mess around with him. Now, he increased interest rates, federal fund rate from 10% to 20%. During that period, because he did this and he got a lot of backlash, trade unions, politicians were all after him, but he stood his ground. He had the support of Ronald Reagan, the President of the United States. He pushed it up from 10% to 20%, and after 3 years, inflation came down from 14% to below 4%. And how did the markets react? Look at what happened to the S&P 500. When he was pushing up rates dramatically and fighting inflation, the S&P 500 fell 27% over a 3-year period. But once he won the battle against inflation, the market staged a huge rally of more than 200% that lasted 4 to 5 years. So in other words, that $5.6 trillion I told you about earlier, that's sitting on the sidelines, will come into play once inflation comes to pass. It will come to pass in time, right? So you need to have but you need to have patience. It's not going to happen in the next 3 months, 6 months. It may happen in 2024, second half, or maybe 2025. But when it happens, the rebound is going to be quite strong. So with that, my summary slide, the markets will remain volatile. because of all these uncertainties we talked about, at least in the short term, inflation, interest rates, recession, and all that, But the good news is that the valuations are not expensive. Interest rates could start falling in 2024 if we see a recession. And that is going to be good news for equities and bonds. But as I said, probably 1 or 2 rate cuts next year. The big ones will happen in 2025. So we still think that, it's very hard to time the markets. And it's important to stay invested. From the standpoint, especially of retirement planning, you can't look in the next 6 months, 1 year to when you plan for retirement. You really got to take a longer term view. This market is not a trader's market. This market is the market where you want to buy and buy very carefully, selectively, slowly, but be patient. So those with a good risk appetite, you must have the risk appetite, I think, for especially equities. And my colleague will cover equities and bonds. But if you have the risk appetite and the patience, and you're able to selectively buy, I think once inflation is behind us, like COVID-19 is behind us, and once the stock market removes its mask, then you'll see a breath of fresh air coming to the markets, and you'll see potentially a nice rally. So with that, I thank you, and I wish you the very best.
Thank you very much, Vasu. Wonderful insights from him as always. And here's a reminder again, if you have questions for Mr. Vasu Menon, please do scan that QR code because we will be posing your questions to our speakers later on during the panel discussion at the end of the session. Now, next up, so after hearing from Mr. Vasu Menon, you want to invest, but you're not sure how much to put in and where to put it, especially when the world seems like it's in a perpetual state of crisis. So to help us build a resilient portfolio, we have the Head of Insurance and Financial Planning, Southeast Asia at HSBC Global Private Banking and Wealth. Please welcome on stage, Ms. Rosalind Fong.
Hi, good afternoon, everyone. I hope you all had a good lunch. Usually at this time of the day, the ZZ monster will creep in and sit among the audience. So, and you see I have a lot to share, but I will attempt to keep it simple, short and sweet. So for the next 15 minutes, I'll try to keep within 15 minutes, yeah. I'll be sharing on how a resilient investment portfolio might look like for you. Next. Okay, okay. In today's society with social media, right? It is very common to hear your friends or your peers telling you, oh, how much money I've made in the stock market, right? And being human, it is so easy for us to develop the fear of losing out, otherwise known as FOMO. And we sometimes recklessly jump into the market without asking ourselves a very important question. What stage of life am I at now? So this is what you see on the screen here today. It's a typical, what I call wealth cycle. When we are younger, we create and accumulate wealth through our income and deploying our savings into various investments that spread from short-term to long-term, and of course, low risk to high risk. But as we journey through the stages of life, our objective will then transit to wealth preservation, and during retirement, what we call decumulation. During this stage, you start tapping into savings that you have accumulated, and you shift your focus into income-yielding products such as annuities, and of course, our CPF Life, which is our own Singapore National Annuity Scheme, or dividend-yielding investments like bonds and REITs. Therefore, the starting point of understanding which stage of life you are at, right, will help you tremendously to determine a few factors. One is how much risk and volatility can you stomach? And two, how long of an investment time frame do you have? And of course, from here, you can ascertain the appropriate type of investments that is suitable for your lifestyle needs. Now, next. Now, as you construct an investment portfolio, knowing what constitutes a core and statter-like investment is key to building a resilient portfolio. There are 3 pillars here: basic, core, and statter-like. Now, the basic is, of course, money meant for short term, right? Your objective is liquidity, is categorized by low risk, low returns. Asset classes that fall into this category would be your savings, your current accounts, your fixed D, T-bills, and also our Singapore savings bond. The core pillar, which is the middle one, comprises of money meant for medium to long term. And the objective is to accumulate wealth to meet your important financial goals, such as your children's education and, most importantly, also your retirement. Now, this core investment, it ought to provide consistent and stable returns with limited downside risk. Asset classes here would be your mutual funds, your exchange-traded funds, insurance policy with cash values, and last but not least, our dear CPF. And lastly, I'd like to just touch on the satellite, which is the last one. Now, this pillar consists of what I call opportunistic money. That is for you to take advantage of market trends or market timing. And it's to make quick return, characterized by potentially higher returns, but higher risk as well. But bear in mind, this may not be for everybody. So what my focus today will be on the core pillar, which is the middle one. Some of the things to note for this pillar will be costs, number 1, 2, volatility, and 3, returns. In order to keep the costs and volatility low, it will be advisable to allocate a large portion to passive investments with a minority in active management to outperform the benchmark to enhance your returns. Now, as mentioned earlier, I said CPF falls into what I call the core pillar. Given the 3 factors I've mentioned earlier, the cost, volatility, and returns, the question now is CPF reliable as a core investment? If it's not, I think many of us here, our retirement will be at stake. Yeah, so in the 2022 Mercer CFA Institute Global Pension Index report, which compares 44 retirement income systems around the world, which covers almost 2/3 of the world's population, Singapore ranks among the top 10 and remains as Asia's top retirement system. And there are key reasons why CPF is so successful. And by the way, I'm not paid by CPF to say this. Okay, yeah. 1, why is it successful? It's because CPF is automatic. It addresses procrastination due to status quo bias, which is all human beings will face it. 2, it is consistent. It eliminates the need for any market timing. And last but not least, it's systematic. It addresses self-control bias due to human emotions and is not subjected to our whims and fancy. So whether you like it or not, 20% will go right in from your income. Right? Now, so the default option, the best part about CPF, which maybe not everyone will agree with me, is if people do nothing, they are still automatically enrolled rather than being left out. And this is actually one of the key, because likewise at age 55, you will have this thing called your mandatory retirement sum. So even if you do nothing, it will be auto-enrolled into CPF Life, which is an annuity that provides a monthly income at age 65 as long as you live. Right? In short, if I could summarize it, CPF is a seamless way to accumulate your wealth and decumulate your wealth, if you remember the wealth cycle that I showed earlier. And that's not all. It is guaranteed by the few remaining AAA credit-rated governments in the world, none other than our Singapore government. Simply put, it's a world-class retirement income system with risk-free, high interest rate. It's as good as a free lunch. So do go listen to other speakers who will deep dive into how you can optimize your CPF. Now, other than CPF as your core pillar, right, in terms of the 3 pillars I mentioned, is it possible to pick the best performing asset class year after year to make up the balanced portfolio? This picture that you see shows the returns of various asset classes from 2008 till year to date this year. Now, each asset class is represented by a different color and it's ranked in descending order, starting from the highest return to the lowest annually. It is clear from this chart that there is no one asset class that can consistently rank at the top in terms of returns. I want you to look at, there's this gray color box here, right? And it is stated as AA. Do you know what that stands for? It stands for amazing asset. Okay, I was just kidding. I was just checking if the ZZ monster is already here. AA is none other than what I call the 60-40 asset allocation. It's a portfolio that comprises of 60% equities and 40% bonds. But just a disclaimer, please note that this ratio is not a magic formula, but it's just rather a commonly used example for a balanced portfolio. Okay. What then is a strategic asset allocation, and is this crucial? So research has actually suggested that strategic asset allocation accounts for more than 90% of the variability of a portfolio performance. Now, in case this sounds quite a mouthful, let me use an example of baking a cake. I'm not sure if any of you here bake a cake. I don't, but I can still quote this example. Now, so when you bake a cake, there are ingredients such as flour, butter, and eggs. What this statement is saying is that the proportion of each ingredient that you use in baking a cake, which is what I call your recipe, accounts for more than 90% of how your cake will taste, rather than the brand of the individual ingredients that you use. So this strategic asset allocation is actually an investment strategy that is based on modern portfolio theory, which seeks to accomplish two competing goals: optimal returns and minimal risk. So based on your risk tolerance and investment objectives and time horizon, you determine the percentage to be invested in different asset classes. So likewise, to my cake example, depending on your diet or your preference, you could reduce the sugar if you are diabetic or decrease the butter if you prefer a fluffier cake. So portfolio allocation often consists of stocks and bonds, although investors may deviate from this to include alternatives such as your real estate, gold, commodities, etc. After all, diversification is key. So, okay, I'm looking at the timer. Okay, so is there a best portfolio? Now, this chart, okay, reflects the maximum and minimum calendar returns, along with the average annualized returns from 1901 to 2021 for various asset allocations rebalanced annually. So each bar here is a different asset allocation. So, you have different proportions of equities and different proportions of bonds for each portfolio. Now, everyone loves a higher return. Who wouldn't? But the trade-off would be more volatility in your portfolio. As I mentioned earlier, 60-40 is commonly used, but there is no one-size-fits-all. What would then be the consideration? Will be one, age. In general, the younger you are, the higher your risk withstanding capacity. And as one gets older, your ability to combat the storms of the stock market reduces. But this is only true to a certain extent. Why? Because this is also highly determined by how much time you have in the market to meet your desired financial need. You may be in your 30s looking to invest for a new home in 10 years' time versus someone in the 40s planning for retirement in 20 years' time. The one in the 40s can afford to take on more risk simply because he has a longer time horizon and he can afford a higher allocation to equities to ride out the fluctuations. But that's not all. What about your risk tolerance, which is related to your need, your ability, and your willingness to take risks? Now, this risk tolerance is what I call a softer dimension because it is by nature more personal rather than formulaic. Now, just because abstract portfolio theory says a 30-year-old should be aggressive in the market doesn't mean that somebody in that age will feel comfortable doing so. So at the end of the day, it's about customizing a portfolio to your needs. And you can also consider other asset classes with less correlation to stocks and bonds, for example, real estate, commodities, gold, etc., to reduce the overall risk. Now, so what's next? What's next after you have set your asset allocation? Now, this chart shows the difference between a portfolio that's never balanced versus one that is rebalanced quarterly. if you see the yellow line, it doesn't mean that the returns are higher. It's referring to the volatility that is straying away from your original asset allocation. So as the investments that make up your portfolio change in value, basically what it's saying is your portfolio will drift away from your original chosen asset allocation. So for example, maybe your original plan was to invest 60% in stocks, 40% in bonds. But the stocks you have purchased gain in value and your bonds, let's say, lose value. Your allocation may have drifted to 70% stocks now and 30% bonds. And this might add significant risk, which may not align to your timeline nor your risk tolerance. So you may have to sell some stocks and buy more bonds to maintain your originally intended allocation and risk balance and risk preference, which is what rebalancing is all about. So when should rebalancing be done? There are two ways. Well, you could do by time, whereby you could just rebalance every year, quarterly, bi-yearly. Or you can rebalance based on tolerance threshold. For example, like what I mentioned earlier, you rebalance an asset class when it deviates from the planned allocation by, let's say, 10% or more. This removes investors' emotions from the decision and rebalances based on actual performance of a given asset class instead of just an arbitrary time period. Now, okay, last part, yes, okay. As you know, to also help one to get started, MES has worked in collaboration with the FA industry, and today they launched this set of what we call basic financial planning guides, right, which basically provides a comprehensive set of rules for the key aspects of a holistic financial plan and highlights government schemes that can be useful for addressing financial needs. Now, given the interest of time, I will not go through every part of it, but whatever you see on the slides, these can be downloaded actually from the Money Sense website. It is what we call the financial planning norms that are launched actually just today. And okay, so most important thing, is what we call the emergency funds as well, right? Whereby in financial planning, we call this your basic liquidity ratio. And of course, the second part, protection. The foundation of any financial plan that you have will never be complete without insurance. Why? Because this is the only asset class that will multiply what you have paid when you need it the most. Right? It may not make you rich, but it will definitely prevent you from going broke. Yeah, okay, so I will, because I know my time is up, so whatever you see here, like what I say, you can actually download from the Money Sense website. And last but not least, this slide basically addresses, the risk of living too long, which is where we talk about retirement and all your investments, right? And of course, legacy planning, whereby, which is what we call rule from the grave. So after you have planned and, accumulate all your assets, make your will and CPF nomination. But what if you are still around but you are mentally not able to make financial decisions for yourself? And that's where the lasting power of attorney and the advanced care plan will come in as well. So more details, again, can be found online. Now, okay, I think we go to the last slide. I already see the ZZ Monster at work already. Yeah, okay. So last but not least, right, now another useful tool that you can utilize is the Singapore Financial Data Exchange, in short, what we call the SG Findex, which empowers you to consolidate all your personal financial information held across different government agencies, banks, insurers, and SGX CDP with a single financial planning application of your choice with more than 10 digital tools. So example is the Money Sense service that provides a step-by-step guide for you as well. Now this will help you better understand your overall financial health and help you to make more informed financial decisions. Remember, you cannot improve something that you don't take stock of. So this will help you to take stock of what you have before you dive in and do a detailed, proper financial planning. Now, so if you need more information about this SG Findex or the digital tools, please approach the staff at the ABS website. Okay, I am done for my segment, and the next speaker, right? He will be deep diving into the different equities and bonds that we mentioned earlier in your asset allocation class. Thank you.
Thank you very much, Rosalind. So, quick reminder that if you have questions for her, please do scan this QR code, head to menti.com to submit the questions. She will be on the panel later on. And isn't it amazing, folks, the SG Findex has made it so easy for us to have a holistic view of our finances. And it's really easy to access also. I do it through my internet banking app. Everything is literally all centralized in there. So if you've never done it before, it's really easy. Just use your SingPass. And do also check out the Basic Financial Planning Guide that Rosalind mentioned earlier. It was launched this morning by the MAS and also Finance Industry Associations. You can check it out on the MoneySense website at go.gov.sg/financial planning guide. It contains 4 simple steps we can take on saving, insuring, investing, and legacy planning. Now, folks, we've been dealing with sky-high inflation for a couple of years now, as Vasu said earlier, and it is not fun seeing prices going up, up, and up. So, with inflation looking like it's here to stay for a while more, how can we position ourselves to hedge against it? To help us answer that question, we're very glad to have the Chief Investment Officer from Maybank Group Wealth Management. Please welcome on stage, Mr. Eddie Low.
Right, good afternoon everyone. My name is Eddie. Very happy to be here to be sharing our views on how we can make use of investment, in particular bonds and equities, to hedge against inflation. Right. I think first of all, what exactly is inflation? How do we measure it? Vasu has talked about US core PCE inflation just now in his presentation. I think in Singapore, one of the common indicators that we use is really this Consumer Price Index, CPI. And as you can see, this index has been moving higher. And specifically, what constitutes this CPI index, right? The pie chart on the left actually gives you an idea that it actually constitutes many different categories, but the top 3 categories or groups include housing and utilities, food, and transport. And for those interested, you can actually go into the SingStat website to look at price trends of specific items. So I went in and took a look. Chicken retail prices actually has gone up by 33% from 2014 to 315 in 2014, by 33% to 418 in July 23. And then during the same period, Mirabus slightly less increase, 27% to 380 per plate, per bowl. And then kopi and tea with milk has gone up by 26%. So going by this data, my wife is thinking that maybe if you want to save some money, you should go for Mirabus, then chicken rice, and then drink kopi with kopio and teo instead of kopi with milk. But is inflation always a bad thing? Frankly, governments around the world has always been looking for a little bit of inflation. A little bit of inflation is actually good in what we call a Goldilocks economy, where you have growth at trend and inflation at trend. In fact, for those tracking Japan, you will know that the country or the government has been stuck in a deflationary trap for many years until now, where inflation was below trend and growth was below trend. But what is happening recently now is actually inflation escalating very quickly in a very short period of time. And that is what I consider as bad inflation. And this happens only when when the economy is overheated or in a situation where there's stagflation. I think 2022 is a classic example when inflation rose very quickly. So if you look at Singapore all items CPI, it went up 6.1%. Other measures of CPI, like for example, all items less OOA, which excludes things like rentals imputed for owner-occupied households, as well as the core inflation, I think it has also escalated. So what this means is that the fast escalating inflation forces central banks to hike their policy rates very, very quickly. So if you look at this chart here, the Fed effective rate, I think that's the light blue line, has gone up very, very quickly in 2022 to to 4%, and now today it's actually more than 5%, right? To combat inflation. Likewise in Singapore, Singapore interest rate represented by the 3-month T-bill rates have also gone up very, very quickly in response to the surging inflation. And because of this very rapidly rising inflation, as well as interest rates, it affected markets. Both bonds and equities were mostly affected in 2022. If you look at this chart here, US CPI, Singapore CPI rose up very quickly. Global equities and global bonds were down almost 20% in 2022. The Singapore bond market also was down to a lesser magnitude. However, there were exceptions. For example, the Singapore STI actually was up 8.4%, partly because it's deemed as a value market. I'll talk a little bit about that later on. Right? But I think it's also important to note that what we have seen last year was really the fact that we had inflation escalating in a very short period of time. But if you take a long view on a longer term period, over a longer term period, global bonds and equities have actually, in fact, historically out or delivered higher than inflation returns. For example, in 2010 to 2019, over the period of 10 years, global equities has actually outpaced the average inflation in the US, as you can see from this chart here. Similarly, global bonds have done the same, although to a lesser magnitude versus global equities. And we see a similar pattern also in Singapore, where Singapore equities actually outperformed the Singapore average in inflation over the period of 10 years from 2010 to 2019. And likewise for Singapore bonds, it's also outpaced inflation, although to a lesser magnitude versus equities. So I think that the data highlights the potential actually of using equities and bonds to hedge against inflation. Because if you look at this period, if all of you, for those who have invested in fixed D, during this period, you'll recall that fixed deposit rates were actually very low, between 0 to 1%. So really below inflation. So zooming into bonds, what are the key features of bonds? When we talk about bonds, these are the key features when we looked at issuer, bond maturity, credit rating, coupon, yield, and currency. But I think what is important to note here is the inverse relationship between interest rate and bond prices. So what this means is when interest rates go higher, bond prices go lower. And conversely, when interest rate goes down, bond prices go up. I think that is an important consideration when you invest in bonds. And another key consideration to think about when you invest in bonds is really, do you want to invest in bonds with longer maturity or shorter maturity? From this table, basically, if you invest in a bond with a shorter maturity, you actually face lower interest rate risk. However, there is a higher reinvestment risk because there is no guarantee that you can actually reinvest at the similar coupon or even higher yield. Conversely, for bonds, longer tenure bonds with longer maturity, you do face a higher exposure to interest rate risk. You do face that higher interest rate risk. However, you will be able to lock in the yield for a longer period of time, so the reinvestment risk is actually lower. Another key consideration for bonds is really for credit rating, and typically we divide bonds into investment grades versus high yield. Investment grades or equivalent means that the default risk is typically lower, but the yield returns is also usually lower for investment grade bonds versus high yield bonds. And then conversely, obviously, for higher bonds, usually they will provide higher coupon returns or higher real returns, although they tend to be usually more vulnerable in a downturn and carry higher default risk. So as what Rosalind was talking about in her presentation earlier on, is all about risk reward. So how do you hedge against higher interest rates or higher inflation with bond investments? So based on what I mentioned about bond maturity and credit rating and yield returns, essentially I think 3 key points to note is, 1, you may want to consider taking or building exposure to more shorter-term bonds if you're afraid or concerned about rising interest rates and rising inflation, because they are less sensitive to interest rate movements, right? They also typically, however, they typically offer lower income unless the yield curve is inverted, which is actually currently right now. They also carry higher reinvestment risk, as I mentioned. The other way is really to look at some floating rate bonds, where the coupon payments actually will move in tandem with interest rates. So when interest rates go higher, the coupon payments will also increase. However, if interest rate were to go down, then the coupon payments will also go lower. The third consideration would be to invest in a more higher yield bonds, because you have a greater income to help you offset the higher inflation. But as I mentioned earlier on, higher yield bonds carry higher default risk, and are more vulnerable in the economic downturn. So as you can see, each option that I've laid out here has its pros and cons. So our suggestion is really to adopt a diversified approach in building a resilient bond portfolio. Now, as for equities, some of the key characteristics when we think about equities investments include, on the fundamental front, the economy, whether the company is growing its earnings, the valuation, whether the PE is cheap, whether the stock is paying reasonable dividends, as well as events risk, whether the company or the business is exposed to political risk like elections, or even geopolitical tensions like war. Right? And amidst higher inflation, potential areas of resilience include companies with pricing power. Investors typically look for businesses or companies with pricing power because these companies tend to have strong brands, strong technology that can differentiate themselves from competitors. So in times of rising inflation, they can pass on their higher costs to their customers to maintain their profitability. The other category of stocks that investors typically look at are dividend-yielding stocks, because there is this, especially for companies who can actually offer steady dividend income, I think that could also help to offer some protection against inflation. In addition, during times of very rapidly increasing inflation, what I consider as bad inflation, investors have also looked at commodity plays as well as value stocks. Let me elaborate a little bit later in this slide. If you look at 2022, the bar chart on the left, you could see that, I mentioned earlier on that global equities were down by quite a fair bit, but you can see that energy stocks was the only one that really registered positive returns. Why? Because in 2022, we had the Russia-Ukraine war, right, which led to higher oil prices because of fears of oil supply disruption. So I think that is actually one area where investors focus on and help to hedge against that inflation or commodity price inflation risk, right? However, if you take a longer term view, between 2010 to 2019, actually energy stock was the worst performing sector, right? In fact, technology stock was actually a better performing sector during that longer term period. So it does suggest that in short term or heightened inflation, energy stocks could do well, but over the long term, it may not do so. Similarly, for value stocks actually outperformed in 2022 versus growth, but it did not do so over a longer term period between 2010 to 2021, right? So, last question that I wanted to ask is, for Singapore REITs, I think that is actually very close to many investors in Singapore. Are they really a good inflation hedge? So I think I laid out this chart to give some ideas. If you look at the returns, total returns in 2010 to 2019, Singapore REITs actually delivered a total returns of about 11%, constituting about 5%, 4% price returns, as well as about 6.6% of dividend returns. So it actually outpaced inflation. However, the returns have been more erratic over the last 3 years because of this rising inflation and rising interest rates environment. Having said that, you could see that there is actually still this steady level of dividend returns, but between 4 to 5%. I think that helped to cushion the returns of Singapore REITs. So I think in a nutshell, investing in bonds and equities does have the potential to offer higher than inflation returns over an economic cycle. For bonds, if you are concerned about inflation, do take a closer look at shorter term bonds, floating rates, as well as higher yield bonds. Although, given the pros and cons, it's always best to take a diversified approach. As for equities, focus on companies with pricing power and dividend yielding capabilities. And if you are worried about very short-term inflation shocks, commodity stocks, and value plays, I think that is something for you to think about as well. But as Rosalind also mentioned in her presentation, investments has its risk. So it's always important to adopt a diversified approach when investing, and that is key in achieving a resilient investment portfolio. All right, with that, I end my presentation. Happy to take any questions in the later Q&A. Thank you very much.
Thank you very much to Mr. Eddie Low. Now, if you've got questions, he's the man you want to ask about treasury bills, all the T-bills and Singapore savings bonds. You've got questions about that, you definitely want to ask him. Scan the QR code, ask him on Menti. We have one more speaker before our panel discussion because, folks, the whole point of investing is to use your money to make more money. But while you're making money, can you also do some good for the world? Can you make sure that your money is being put to good use by companies doing the right thing for our planet? The short answer is yes, you can. And to share with us how, we have the Executive Director, Sustainability Lead, Group Personal Financial Services from UOB, Mr. John Lau.
A very good afternoon, ladies and gentlemen. It's a big pleasure to be here. Thank you so much, MAS Money Sense and CPF Board, and my fellow esteemed speaker, and of course, Edward, our dear MC that has taken care of all of us today. So, long session for all of you, especially after lunch. I had lunch as well, so I know it's not easy to actually stay awake, but last speaker to go before the exciting segment of Q&A, so just please stay with us. As a financial practitioner for 20 years, I've been dabbling myself into wealth and capital markets for most part of career. And when people ask me about what is sustainable investment, I start to think about it. Actually, yeah, it's just like, you know, my day job right now, right? Beyond helping customers with wealth management and financial planning, by offering the right solution, advisory, as well as services, we've actually integrated the elements of environmental, social, and governance into our daily work. It started off as actually something of a passion, a little bit more of a hobby, but little do I know, 5 years down the road, many things have changed. And this is no longer what people used to call a CCA, but something very real. And I will tell you what's the reason. So today, we'll take you on a very simple journey on sustainable investments. Why that's important to everybody here, why you should not be missing out, and what are some of the common milestones and standards that has been established to protect our investors and also ensure that we actually uphold a good standard when it comes to offering sustainable investment strategies. But also then I'll end up with what are your fellow Singaporeans thinking and are currently doing when it comes to sustainability. So, sustainable investments, as I was referring to earlier, is a combination of two things. Number one, your traditional investment instruments, which take care of your financial matrices and consideration, such as, let me try the laser pointer. Okay, it didn't quite work, doesn't matter. Return on investment, investment horizon, risk appetite, and financial objective that just now our colleague Rosalind has actually kindly covered. However, now you add on things from an environmental, social, and governance perspective, right? Which is actually the hot topic right now, because I'm sure everybody is feeling, number one, very hot this year. It is the hottest year in 174 years, go figure, right? And then, now we have haze as well. Haze is a complex issue, right? Because it is both a climate, but it's also a social issue as well. Think about that. So, what is actually driving sustainable investments? And the good news is we're actually standing on the shoulder of giants. Since the 80s, quietly, okay, not very quiet, but they have been doing a lot of research, a lot of policy delivery, all the way from Kyoto Protocol, PRI, the Millennium Development Goal, which is the predecessor of what you have been familiar with, the big rainbow there, the Sustainable Development Goals driven by the UN, to actually locally, our own version, which is the SG Green Plan 2030, to right now, this year's milestone, the International Sustainability Standards Board announcement, which will now be setting a common language, right, for sustainability disclosure across 140 countries moving forward. Why that's important? Because you cannot manage what you cannot measure. So imagine 140 countries previously were all talking different languages. I think it's actually quite hard for anyone to comprehend, correct? Especially if you are an analyst sitting in New York trying to understand what's actually happening in all these different countries. But now, we bring everything together, make sure that everybody speaks one language. In this case, maybe AKA English, right? But that's in the sustainability word, so that we can then really look at, oh, this company is operating in Canada versus that company that's operating in Cambodia and China. They are all using the same standards. That is how important this particular milestone is. And talking about fear of missing out, sustainable investment is actually a mega trend today. By 2025, 1/3 of global investment AUM will be deemed as sustainable. So, whether willingly or unwillingly, knowingly or unknowingly, every $3 that you invest is $1 is going to be sustainable. So I thank you in advance first, because I believe everybody is here because you're all investors. Now, because of that, in the next 10 years, we think, number one, every company will now have to establish a climate strategy. Why? Because that would be driven by what I just told you, the ISSB standards, which is actually international requirement for a company to show their report card. You cannot hide anymore. You must actually stand out there and tell people, okay, this is what I'm doing as a company, and this is how my performance is. And more importantly, what are the plan and strategies that will impact my daily business operation? And then what kind of investments am I going to make? I.e., upgrading my factory, retrofitting my facility, right? These are the things that the entrepreneur of today and tomorrow will need to consider, and this will actually materially impact their ability to raise funds. Why? Because many financial institutions right now are actually being watched. So not only the companies are actually being targeted, or now even banks. When we need to raise funds and lend people money, people will ask, hey, have you done your due diligence? Are you sure the funding is actually going to the right sources, right? How do you ensure when people say that this money raised through a green bond is indeed going through to actually finance the building of solar panel factory, right? So these are important issues that we now as an industry collectively need to ensure, because every single dollar that we raise from our customers now, we have to then make sure that it goes to the right proceed. So that's why sustainability is important. And coming back locally, SG Green Plan 2030, I'm sure many of you here are aware of this plan, but it is actually driven by 6 pillars, right? From city and nature, sustainable living, energy reset, green economy, resilient future, to green government, within which multiple initiatives that would actually impact us, not only as an individual and a household, but also as an employee, as an investor, or a business owner, right? So this is important that, that you are actually aware of this particular development that seeks to achieve what? The Green Plan seeks to actually strengthen Singapore's commitment under the UN 2030 Sustainable Development Agenda and Paris Agreement and position us to achieve our long-term net emission aspiration by 2050. So a few things. Number one, key targets that may be relevant to you. We will quadruple our solar energy deployment by 2025. So a lot more solar energy, right? What does that mean? Business opportunity, because we are building stuff. That's good, actually, from an investment perspective. Number two, we'll reduce the waste sent to landfill by 30%. So, again, changes in terms of supply chain, logistics, would also create opportunity. And a lot of it actually will rely on every one of you here, make a little bit of changes in terms of lifestyle so that we aid, right, the reuse, reduce, and recycle agenda a little bit better. And of course, number three, 20% of our schools will be carbon neutral by 2030. And last but not least, not so good news for you petrol heads out there, all new registered car will be cleaner energy model. So if you're driving that big 4-liter V8 engine, it's time to make a change. So enjoy it while we still can, but you should make the change now. Okay, greenwashing is actually a very, very important agenda because now you see a lot of different companies are claiming that they are green, but are they really green, right? So how do we then ensure that we don't fall prey to practices offered by different organizations that may mislead customer, investor, and other market participants, stating green but not that green? I'm a coffee lover. I love my Starbucks whenever I go around the world, but it was actually a bit of a surprise when their strawless lids actually uses more plastic than the old straw and lid combined. So what do? I buy a Starbucks flask. Works too. And so that I don't even need to use their cup moving forward, I just go around everywhere with my own flask, right? Avoid that problem. But this is it, one example. To avoid greenwashing as an investor, 3 things you can do. Number one, right? Procure through reputation as well as research. Make sure that you actually consume from companies that are actually constantly on top of key sustainability agenda. Number 2, look at certification, right? Make sure that when people claim they are sustainable, look at their certification. Third-party audit is important, right? Because it's not about how sustainable I claim I am. If I'm really that sustainable, I will hire an auditor to come and look at my processes, to look at my products. Let them be the judge. And of course, last but not least, sustainability constantly evolving. I went away for a 2-week break. I'll come back. There are new things. So stay alert and always keep up to date. And of course, as a retail investor, there are established guidelines on retail ESG fund to protect our Singapore investor. So thanks to the good work of industry colleagues as well as MAS, you now are able to go to MAS Opera portal to actually take a look at your mutual fund. Scan the QR code here and punch in your fund details. They will tell you whether the mutual fund actually meets the criteria or not. Why that's important? Because that is actually a big milestone when it comes to standardization. When I first started off looking at sustainable investments, we actually lacked a local assessment criteria. Many of us were actually looking at the European standard called the SFDR. But then we start to think about it. If as Singapore progress, right, as a financial hub, we need to then establish our own standards. So this is actually our response. And I'm very proud to be able to tell everybody I contributed my little part, right, in the development of this particular guideline. And why you want to actually get involved in sustainable investment? Because every one of us have our own values and preferences. I remember when I was a young kid, my dad used to subscribe National Geographic magazine. It will be everywhere in my house. And every day at 9 p.m., my dad would sit me down and say, let's watch National Geographic and put away whatever that you're reading right now. So that developed a love of nature, a love of wildlife, a love of biodiversity, which is why today when I do sustainable investments as part and parcel of my business as usual work, I'm always energized because that aligns to my principle and aligns to my value. I make money for my institution and my customer, but yet I know at the same time I'm doing good. Twist it around from an investment as individual perspective is the same thing. In Japanese, there's a calling called ikigai, right? meaning that you love what you do, correct? You actually be very good at what you do. The world needs what you do, and hopefully you get rewarded for what you do. And sustainable investment is just like that. We are just trying to make sure that when we're making money, can we also do some impact to the nature? So, sustainable investment strategy, 3 ways you can go in. Number 1, ESG integration is about integrating sustainability factors into our assessment criteria when it comes to selecting an investment solution. Number 2, thematic. Look for a topic that is very close to your heart, right? Climate action, biodiversity, right? Social equality, different things. Actually, you are able to find access. And number 3, impact investing, right? So this is really about using various forms of investment instruments to make a positive impact that is aligning to the 17 UN Sustainable Development Goals. And how do you access into this? You can do it through unit trusts, bonds, exchange-traded funds, real estate investment trusts, and even insurance-linked products. Today, sustainability is no longer exclusive. It is actually a mainstream. So with that, I want to close off with our latest ASEAN Consumer Sentiment Survey, right, commissioned by UOB. Sustainability highlights. What are your fellow Singaporeans thinking? Number 1, 60% of us will consider sustainable investments. Number 2, 9 out of 10 Singapore consumer actually feels that financial institutions should offer more sustainable investment solution. And number 3, more than 85% of Singaporeans think that sustainable investment enables them to achieve financial return and do good for the environment and society. So a parting thought, have you invested? If yes, great. If not, you should start tomorrow, because if you're worried about inflation, you need to start to look at sustainable investment, because that is going to be here to stay. With that, thank you very much.
Thank you very much, John. Please remain on stage. We'd like to welcome back all speakers back on stage for the panel discussion now. Also, if you'd like to ask them questions, please do submit them through Mentimeter. We know that a lot of you have submitted the questions already. We really appreciate it. Thank you so much. And we'll try to get through as many as we can in the next 20 minutes' time. All right, please have a seat, grab your microphones. Vasu, I'm going to start with you. Actually, this is for all our panelists. It's a simple question. Because we're here, this event is organized by the CPF board. So, Vasu, if it's risk-free, why don't we just put all our money in CPF?
Well, basically, I'm the market outlook person. They should be answering this question. But nevertheless, I think that, from the perspective of investments, what I've learned over the last, 35 years, I've been in the investment industry for the last 35 years, is that you never throw all your eggs in one basket. So, of course, look out for investments that are risk-free. But I think you also want to make sure that, you take on a bit more risk if you're able to, and especially if you've got a longer runway, right? So for somebody who's very young, it doesn't make sense for them to be too conservative either, because you've got a long runway. Basically the asset that you have is that you've got a long runway. So take advantage of it. Don't undermine it. Don't underestimate the value of it. And if you've got a long runway, you can afford to ride out volatility, you can afford to ride out risk. And so take on a bit more risk when you're younger and you have the risk appetite. But I think it boils down to eventually the individual. You must be somebody who can take on risk and be able to sleep at night. If you have butterflies in your stomach after investing in something, then it's hard, So I give an example. Like when I was in 2002, I had a client who wanted to talk to me, and I advised the client, perhaps put some money into India. And so the client did put some money into India. He said, look, I've got the risk appetite and everything else, so don't worry. I want to take on risk. So I told him, put some money into India. So put some money into the Indian stock market. And then what happened was the Pakistani militants attacked the Indian parliament. And in the next 48 to 72 hours, the Indian stock market came off very sharply, I think about 7 to 8%. And he was furious. He SMS'd me and he said, I didn't invest to lose money. I invested to make money. So what have you done? And I said, look, this is geopolitical, it's sentiment-driven, I think give it some time, because when you invest in the markets, you take a long-term view. Don't invest in a short-term view. And guess what happened? In the next 3 to 5 years, the Indian stock market rallied by 150 to 200%. And he was very sheepish when he saw me in Takashimaya, because when he saw me, he said, I'm sorry about what I said My SMSs came across quite strong, but he was happy. And, he made the money. So I think the key message is this. Don't get too flustered by what happens in the short term because of, volatility in the markets, especially because of sentiment. I think when you're investing in the markets, take a long-term view. And if you're a young person, you can afford to take a long-term view. But even if you're an older person, I think it's perfectly okay to do that. So yes, it makes sense to put money into risk-free instruments. But at the same time, don't write off your opportunity to make better returns, especially given inflation. You want to beat inflation, and you want to keep a more a more diversified portfolio and have eggs in different baskets.
All right, Rosalind.
Yeah, since Basu said I should add on, right? Yeah, okay. Now, even if, yes, I think it makes sense to actually, like the question asked, to top up your CPF, but there's also a limit. So even you want to top up like 1 million, you can't. There's a limit. So whatever excess that you have after you top up, yeah, that's where you can actually diversify into other investments, like what Basu said, to take opportunity in the market. And also for CPF, one of the things is to note is once you top up, right? Once you go in, it cannot come out. Yeah. But Wealth investment, you can still liquidate it and then you can still take profit. Yeah.
All right. Thanks for that.
Maybe just quick one in relation to my presentation. I think there's nothing wrong to invest in, keep your money in the CPF because if it helps you to sleep better at night, right? But there will be times where your CPF rate is not going to be enough to compensate for the rise in inflation, like, for example, last year. So that is the risk that you have to be conscious of.
Yeah, when inflation outpaces your CPF returns, what's going to happen there? John, do you want to add anything on this one for the CPF question?
Yeah, I think we talk about long term, right? And I think the CPF has actually done a good job protecting the savings of Singaporeans, right? And I would say that across the world, from a sustainability perspective, in fact, the growth were predominantly driven by actually sovereign wealth fund and pension funds across the world, right? As the first wave. And which is why, if you don't know any better, you always follow the flow, right? There was one old saying, right? Like, you don't fight the Fed, for example. So if you are thinking about managing inflation, I would actually urge everybody to also consider new areas, right? Which we would usually term it as mega trend, meaning trends that you see that is starting, hopefully that you can ride on to it, and it should actually shape the future and stay on for the next 20 or even 30 years. Because in this case, time is not our enemy. Time is actually your friend, but choose the right trend. Hence, I'm advocating for sustainability because you look at it, 10 years ago, who would have imagined we would have so many EVs roaming around, right? We were thinking, oh, there's no way that I cannot drive to KL, cannot drive to Penang, but it has changed. Look at how US has implemented it. Look at how China now, the #1 solar panel producer in the world, 60% global market share, if my memory serves me right, and their technology is now world #1. They have surpassed Germany. So, Megatrend, take a look at what you think the big boys are doing, follow it. That should work.
And they do it the cheapest too, China. They make the best solar panels for the cheapest, at the cheapest rate. Their margins are amazing. So thanks for that, John. I'm going to try to get through as many of your questions as possible. Thank you for submitting them. So I'm going to invite the speakers, one or two of you, to answer each one. We'll start with AI, because it's been something that people have been talking about non-stop this year. So when it comes to investments, okay, how can you use AI tools to invest, but also to plan for retirement? Do any of you have any insights on that?
Actually, can I start?
John, go ahead, please.
That's not scripted, by the way. I'm not supposed to talk about this. Anyway, we use AI for a great many things today. In fact, a lot of times when I need a frame, I will check with my best friend, which is ChatGPT first. What it can give you is actually a very, very good concept and framing. However, the human intelligence and experience, to me, is still critical. It sets the ground rule of what you should be considering, but when walking the path, one still have to do it. I was reading this book, right, about, written by this gentleman, I think one of the co-founder, right, of ChatGPT. Statistically speaking, AI is now improving the productivity of many industries, right? It cuts into academics, it cuts into finance, etc. So it really does help us to simplify our work a lot more and make us more efficient. And hopefully by delayering all these very manual tasks, then the analysts and the investment specialists can then spend time on things that matters. So that's my view.
Thank you for that. Yeah, as they say, Kathy Wood, I think it was said, she said the superpower of AI is actually productivity. That's what it actually really adds to humanity. Next question is about timing, I think. This one. In the next 6 to 12 months, so short term, should we save cash and wait for the next investment opportunities? This viewer here is expecting interest rates to drop and also for equities to weaken as well. So should they sit on the sidelines for the next 6 to 12 months? Eddie, this is probably for you.
Yeah, I think there's this saying, time in market versus market timing. We all know that it's actually very difficult to really time the market. For those tracking market observers in the beginning of this year, most consensus are talking about economic recession. And then if you recall Russell's presentation, equity markets were actually up nearly 20% in the first 7 months of the year. So that actually proves market timing is very difficult. So I think on our front, we do advocate, I mean, you can try to time the market, but on a very tactical satellite basis. I think it's important to really ensure there is time in market, especially for your core portfolio, as what Rosalind has suggested. And using a strategic asset allocation approach, I think that will help to ensure a resilient and, a smoother ride. And again, help you sleep better at night. That's very important for me.
Thanks very much, Eddie. And also a reminder, if you're not sure, speak to a professional about this. Get some help. It never hurts to get a professional opinion from someone who is licensed and educated and qualified to do this. Next question is probably for you, Rosalind, because this one is asking about an ordinary family is probably going through really tough times right now. All right, prices are rising, the wage probably isn't keeping up. So what should they do if they're the head of a family? What steps should they be taking right now, Rosalind, to deal with these difficult situations up ahead?
Okay. I think, as I mentioned earlier, the foundation of any financial plan is you need to set in place risk management tools, which is what we call insurance. And just now when I showed the financial planning norms, right, is about using term insurance. So term insurance basically will help you to meet your need at the least cost. Okay, so this is what I call the basic. Yeah, once you take care of your basic, your foundation, then I mean, because this question seems very generic, but the other thing is after you have taken care of this, given that if you are already very stretched, then instead of investing into satellite investments, right, which some of our experts here are talking about, you may just want to focus on your core. Yeah, because put it very simply, right, if all things fail, right, you still have a core to rely on. But if you put all your eggs in your satellite, you must get it right. And the truth is, if you look at a lot of research, even the fund managers get it wrong. Nobody gets it right all the time. So therefore the core is actually fundamental. Okay, and I just wanted to just add on when we talk about the topping out of the CPF life. Topping out of CPF. That this thing called, I'm sure Albert Einstein, you have heard this saying, the magic of compounding interest. Now, so don't underestimate this thing, yeah. And some maybe you might feel that if I invest, let's say, $300 a month now for my retirement, right, it may mean nothing. But the truth is, if you would really look at the numbers, because I'm a numbers person, so So if it's you just invest 300, right? For let's say, let me get the numbers in my head. I did some calculation earlier. So $300 a month, right? For 20 years, right? You will get about 100,000 if it's at 4%, right? Now, if you wait 10 years, you need to invest more than double. 300 is 3,006 a year. But if you wait 10 years, you have to invest almost 9,000 to get the same 100K. Okay, now, so back to this 100K. So you may feel 100K only, no big deal. This same 100K, if you could put the same 100K into at age 55 and top up your retirement account, that will translate to your CPF life. Let me tell you what this 100K will mean to you. It will mean that when you retire at 65 years old for a meal, it will be another extra $750 a month as long as you live. For women, unfortunately, because we live longer, our rates are, I don't know, is it a good thing or a bad thing, but we get a little bit less, $50 less. So it's 700 a month as long as you live. I don't know about you, but having another extra $700 is something that I wouldn't mind having. Yeah, so when you work backwards, you start small. What I said was only $300, right? So if you take a net income of $3,000, it's about 10% of it, yeah. So again, back to the financial planning norms, they recommended at least take about 10 to 15% to set for your retirement goals, yeah. Sorry if my answer is a bit long, yeah, because I
Lots of wisdom there, though.
Sure.
Thank you so much, Rosalind. Encouraging you to save and invest at least 10% of your income. That's a very good guide. Vasu, next question's for you. Somebody's invested in stocks right now. There's a possibility, you said, that the market may come off quite a bit. Is it a good time to lighten up on stocks?
Why do I get all the tough questions, Edward? Okay, this is a tough question. But the way I see investments, it is a journey. It is not a short-term thing. So yes, you could see the markets crashing, pulling back sharply. So I don't know this person. I don't know who's asking this question. I mean, eventually you've got to understand the person's background, risk appetite, so on and so forth. But I would say that, essentially, if you've got a very large percentage of your portfolio in stocks, or if you're 100% in stocks, then that may not be the best approach, because I think you got to make sure that you are diversified. I'm a firm believer in diversification, and so you got to make sure that you have a certain percentage in stocks, some percentage in bonds, some percentage in safer things like T-bills, Singapore savings bonds, for example, fixed deposits, and that sort of thing. Some percent in even gold. Because gold is an insurance again. So you want to keep it diversified. But of course, if you're heavily invested purely in stocks, say 90%, 95%, and you don't have the risk appetite, yourself, you don't have the risk appetite, and you're a slightly more advanced age like me, then you want to make sure that you are a bit more careful, right? And you want to maybe pare your holdings down and either keep it in cash and wait for opportunities, or divert it into other asset classes. I think trying to time the market perfectly is hard. Just by a show of hands, when the markets crashed in 2020, COVID-19, and most markets fell by 35, 40%, how many of you invested right at the bottom? Do you mind if I have a show of hands? Okay, quite a number of you, but I'm glad.
Very, very
I'm very happy for you.
Here.
I'm very happy for you. But the psyche at that point in time, right, is that when the markets are there, down there, all look so gloomy and dismal, very hard to buy. And it takes a brave soul to jump in and buy. Right? So sometimes you miss the boat when it's right at the bottom. So yes, now given the uncertainties, I'll probably want to have more cash than usual on the sidelines, but I certainly wouldn't get out of the markets completely, because the markets can surprise on the upside as well. You never know. For example, if somehow the Ukraine war comes to an end through a negotiated settlement, the markets will fly, right? Because then inflation, they've been a major source of inflation, that starts coming down. So, things can happen. The unexpected can happen, right? Yeah, Donald Trump wins the elections. Good or bad for the markets? Interesting question, right? We don't know what the answer is, but a poll done by Gallup just a few days ago in America shows that most Americans believe that the Republicans do a better job running the economy than the Democrats. So if a Republican president comes in, maybe Donald Trump, we all think the markets are going to crash, but maybe people think he's pro-business, pro-economy and everything else, and that might cause the markets to rally. So we don't know, you see. There's so many of these things that are playing out all the time. So I think I would really prefer to take an approach where you invest gradually over time. That means a regular investment plan, but of course have some cash for this kind of tactical opportunities when you see sharp corrections in the market. But just to hold on to cash and just wait for that correction to happen in 2024, 2025, I don't think that's a good approach.
Yep. So thanks for that, Vasu. Maybe consider DCAing. Last question is for Eddie. So this was specifically to the CIO of Maybank. So in this case, should we invest in REITs instead? Just REITs. Let's go.
Right. I think there are merits to consider investing in REITs, but given the economic downside risk that actually Vasu has mentioned, there is a need to be more selective. So when you look at REITs, you have to take a look at the portfolio of the REITs. Is it well diversified, or is it just relying on one single major tenant? Obviously, the more well diversified you are, then the more resilient your income is. Then the second question you may want to ask is actually, is the REITs, what is the leverage ratio of the REITs, right? Is it highly indebted? Because when you're highly indebted, rising interest rates will give you more problems in terms of financing, in terms of interest rate expenses. And then lastly, you also have to take a look at the valuation. How is the REITs currently priced? Is it reasonable or is it expensive? So as I mentioned in my presentation earlier on, you have to consider all these factors collectively, then you'll be able to make an informed decision.
All right, thanks very much, Eddie. I'm going to start with John. We're going to work our way back. One last thing for our audience. What do you think is one thing they should take away today that they should keep in mind when they're thinking about their money and where to put it?
Well, for me, first of all, I'll go back actually to Rosalind's $300 question, right? So in order to have that $700 to spend upon retirement, how do we then accumulate and change our little habits, right? If some of you have read the James Clear book on Atomic Habit, I think it's amazing. Check it out. Is going back to our roots, right? Frugality, something that actually, Asian Hokkien descent will be very proud of, right? Because we will save for rainy days, and a lot of that actually takes a little habits that can help to then accumulate into something sizable. So I would urge everybody to review your lifestyle, think back and look at where you can actually potentially start saving, and then from there, we will channel that into the various investment options that Vasu, Rosalind, and Eddie has actually suggested. So that is what I hope the audience can take away.
Thanks, John. So spend within your means. Eddie, one piece of advice you want everyone to take away?
I'll just reiterate in the message, right? There is potential of using investments like bonds and equities beyond just cash to hedge against inflation, but do it, invest in a diversified manner to make sure you have a resilient portfolio to achieve that objective.
Thank you, Eddie. Don't put all your eggs in one basket. Very good advice there. Rosalind?
Yeah, I think if I could, one point will be don't procrastinate. Yeah, don't wait for the stars to align before you take action. Even if it's a very small action, even if it's not $300, if it's $100, as you start right, you will start picking up momentum and you can start tweaking along the way. Yeah, so if you can, walk out the door and start today. Yeah.
Thank you, Rosalind. Open your banking app now. Check your SG Findex. And last word goes to you, Vasu.
Yes, I mean, investment is a journey. It is not a short-term thing, it's a journey, right? It's not exciting sometimes. So draw a distinction between trading and investments. If you're trading in the market, then you're looking for excitement. If you're investing in the market, then you're looking to make money in the longer term. I think that's very, very important. And finally, just want to say, although I shared about recession and everything else, I think it's important not to be too negative about the markets from a macro perspective. Some of the things I highlighted are headwinds, but don't forget, dark clouds never last forever. Blue skies will emerge, and one should not be too negative, because eventually when things start to improve and the coast looks a lot clearer, don't forget there's a mountain of cash sitting on the sidelines looking to get into the markets, and when that mountain starts piling into the markets, you'll see a nice run-up. So don't miss the boat because you're overly cautious, overly conservative. Thank you.
Thank you for that. Please give a big hand to our speakers, Mr. Vasu Menon, Ms. Rosalind Fong, Mr. Eddie Low, and Mr. John Lau. They've shared wonderful insights on how we can build resilience and protect our investments in times of inflation. Also, very big thanks to CPF Board, of course, and MoneySense for making this session possible. Now, ladies and gentlemen, please do share with us how we can improve our next seminar or what other topics you'd like us to cover through a short feedback form. Scan the QR code shown on screen for that feedback form right now. And for more financial planning tips, please do check out the booths outside set up by our partners. They're just outside this hall. If you sign up for the next session, that's also in this room. There are 3 sessions going on later. Please do exit and re-enter again as we're keeping track of the attendance numbers. And thank you and have a wonderful weekend ahead. Goodbye, everyone.